We're joined by Ralph Schlosstein, Evercore Chairman Emeritus and BlackRock co-founder. Ralph, really nice to see you this morning. Welcome to the studio. Thanks very much for joining us. Let's start with your sort of in-the-moment market expectations. There's a lot of people wondering whether we're going to get a cut of 25, 50 basis points from the Fed next week. Seems to matter. I wonder if, in the grand scheme of things, that's the sort of thing that matters to you because of the signalling it might give to markets. What are you thinking?
I do think it does matter, and if I were in the room, I would actually be pushing for a 50 basis point rather than a 25 basis point cut, not because I think the economy is on the verge of recession, but I think the balance of risks has shifted from a risk that inflation doesn't come down as we hope to a risk that unemployment grows up faster than we would hope, and employment doesn't grow as fast as we would hope. And as a result, I think the argument for moving toward neutral is a pretty strong one.
Okay, so you're in the 50 camp.
Yes.
Would that be would a 50?
I'm not saying they'll do that.
Sure.
I'm saying that's what I think they should do. Yes.
So if we, is there a danger though that if they did 50, that spooks the horses? Would this be taken as risk on or risk off? Do you think by markets?
I think I believe the right thing to do is 50 for two reasons. One, I think the balance of risks are more in the slower employment growth. And second, we're quite a ways away from neutral. The risks, even if they are balanced, we should be closer to neutral. And I think a path which starts at 50 rather than one that goes 25 and then 50 actually communicates a more relaxed view about how the economy is doing right now. Whereas if you started at 25 and then in November did 50, it would actually spook the market a little bit.
Good morning, Ralph. So just listening to that, you're fairly confident that a 50 would not signal that we're in a hard landing?
No. I think, we're so far, obviously when we were at zero, we were a long way from neutral.
Yep. At
5.25 to 5.5, we're also a long way from neutral. And if the risks of slower employment and inflation are roughly balanced, we should be closer to neutral. And to me, the statement should be, we now have balanced risks. If anything, we have a little more risk that employment is going to grow too slowly, and therefore we should be getting on with the path, getting to neutral.
Just to break it down a little bit, which bits of the U.S. economy do you think need rate cuts right now? Is it the private sector? I look at company margins; they look fantastic still, really good. Is it the employment story, or is it the government that needs a rate cut right now?
Well, the government benefits from a rate cut, but the parts that I think need a rate cut are the rate-sensitive sectors like housing and smaller business where all of their borrowing is tied to short rates, prime, lines of credit, et cetera. And so, and by the, big business is doing great. Margins are high. Top line growth is decent. So I don't think the case is, in the S&P 500 or the Dow Jones. The case is in the part of the economy that actually generates the vast majority of new jobs.
How much of that strength, though, is at the whim of what might happen in the political space in the next 6 months? I'm curious, if we're talking about these interest rate cuts and this resilience, how much should the Fed be thinking about the continuity or the potential increase of tariffs in the next 6 months?
Well, the Fed would always say that they react to the economy, not to fiscal policy or to trade policy. And I think that's basically true. I think we're in a period right now of significant economic uncertainty. We're in this transition period from when inflation was too high and it's now coming down. It hasn't quite reached the Fed's target yet, but it's certainly moving in that direction. And unemployment is drifting upward. And, as you just heard from the former Commerce Secretary, there certainly is, some risk that we will have not a soft landing, but a mild recession. All of that means there's uncertainty. The political period adds additional uncertainty, and so that's kind of a chilling effect on significant moves by business.
Well, Ralph, famously in 2019, Jay Powell basically announced an insurance cut to address the pain from tariffs, which is why I'm wondering if that playbook sees a little bit of a repeat, and if tariffs are even something the market and the economy has gotten used to, or maybe is the budget perhaps the bigger worry?
Well, I think you have to separate what I would call trade balancing or tactical or targeted tariffs and blanket tariffs. Blanket tariffs, I think, presage, and high tariffs presage a period of declining free trade, which we've already entered somewhat. And that is inflationary and very bad for markets. So if that happened, I think we'd certainly see an effect in the markets. The impact in the economy would be, always uncertain.
Well, we're already seeing, you mentioned the difference in blanket tariffs and target tariffs. We're already seeing that kind of a continuation of not just the Trump era, but even in the Biden era, a continuation of tariffs, not just on China, but on Europe as well. At what point is that so damaging to the economy?
Well, the magnitude of them has not been that great so far. And I think as a general matter, the Biden administration has tried to balance what they would call fair trade and a reasonable relationship with Europe and our allies in Asia, and not a whole-scale attack on free trade. Being the special trade representative in the Biden administration has probably not been the most exciting job over the last 4 years.
Yeah, maybe. Let's talk about areas of the market that might be exciting and talk about deals, because that's something
right.
I'm sure you have views on. We're just seeing another example this morning. Digital Bridge sent away the sale of a $4 billion firm, EdgePoint. Just another example of maybe some deals going through. We heard from Barclays this week, Goldman Sachs this week, both saying things are starting to pick up on the deals front. Wishful thinking or actually seeing evidence of that?
Well, there's definitely some pickup in the announced activity. If you look at the first 8 months or so of this year, the dollar volume of announced transactions is up. Interestingly enough, the number of transactions is still down this year. There's if I look at Evercore's business, we track a number of indicators. The least forward-looking is our backlog, which is tangible. The other measurable ones are new engagement letters signed. Earlier than that is new conflicts clearance, when a client calls us up and says, hey, we're thinking of this, will you help us? And even earlier than that, which is not quantifiable, is active dialogue with our clients. The active dialogue with the clients is way up. New engagement letters is up. And conflicts clearances are up somewhere in between those two. So there's definitely a significant amount of pent-up activity. As we talked earlier, we're in a period of economic uncertainty. Economic uncertainty is the enemy of announced activity. So it's going to happen. It's a question of when it really starts.
Do you think the Harris camp is generating economic uncertainty? We don't know yet what the Harris camp is going to deliver in terms of its economic agenda. We seem to be light on detail. What is your sense of that?
Well, I'm not sure if I had a scale here and I watched the debate on Tuesday night, which I did at 2 a.m., that if going down was on the one side was how specific was the candidate in terms of their economic policy, I'm not sure that the Trump side would go down more than the Harris side. So I think that both of them are trying to say as little specifically so that they don't offend anyone. I actually think she's been more specific than he has, at least in the last, since she's entered the race. So I think the fact that these are two very different visions for America definitely, and it's a toss-up, definitely injects uncertainty. But I wouldn't put her policy as being a principal contributor to that uncertainty.
Well, you talk about her specifics. Her campaign has certainly outlined, as she has as well, in terms of a continuation of the Biden policy, which is tackling drug pricing. She's talked about grocery prices, housing affordability. Economists and investors would listen to that and hear that and be concerned about that being a recipe for stagflation. Do you agree?
No, I don't. I think that there are two elements to her policy. And by the way, I am a Democrat, so take this all with a grain of salt. I think there are two elements to her policy. One, it's a torque the benefits of our society a little bit toward the middle class and those less privileged. And I think her policies on housing affordability, drug prices, child care, and the child tax credit all are geared there. And, there's going to be a massive debate next year about the extension of the Trump tax cuts. And I think the biggest difference between these two is the position that they will take on that, whereas Trump is for extending all of them and for, in fact, expanding some of them on the corporate side. And she is clearly for expanding all of them for those below $400,000 in income and cutting back on the corporate side. She's proposed 28% rather than 21%, and probably eliminating some of the cuts that are beneficial to the most wealthy in our society. I think it's a policy focused on a little bit of retorquing toward the middle class and below, and a growth agenda.
The counter argument of that simply would be that the Trump tax cuts did great for the economy. Jamie Dimon has made that point. A conversation for another time. Ralph Schlosstein, we have to leave it there. Evercore chairman, emeritus, and BlackRock co-founder, we thank you so much for joining the program.